Hi, this is Money and Investing. Companies use the price-to-book ratio to compare a firm's market capitalization to its book value. For assets, the value is based on the original cost of the asset less any depreciation, amortization, or impairment costs made against the asset. By the way, if you like this kind of content, it'd be awesome if you'd hit the like button and subscribe.
It'd be a lot cooler if you did.
Here are a few key takeaways. The PB ratio makes the market's valuation of a company relative to its book value. The market value of equity is typically higher than the book value of a company. P/B ratio is used by value investors to identify potential investments. The P/B ratios under 1 are typically considered solid investments. Book value per share is calculated as follows: total assets minus total liabilities divided by number of shares outstanding. Market value per share is obtained by dividing a company's market value by its shares outstanding. The price-to-book ratio equals market price per share divided by book value per share. A lower P/B ratio could mean the stock is undervalued. However, it could also mean something is fundamentally wrong with the company. As with most ratios, this varies by industry. The P/B ratio also indicates whether you're paying too much for what would remain if the company went bankrupt immediately. The P/B ratio reflects the value that market participants attach to a company's equity relative to the book value of its equity. A stock's market value is a forward-looking metric that reflects a company's future cash flows. The book value of equity is an accounting measure based on the historic cost principle and reflects past issuances of equity, augmented by any profits or losses, and reduced by dividends and share buybacks. The book value is the net assets of a company. In other words, if a company liquidated all of its assets and paid off all its debt, the value remaining would be the company's book value. The price-to-book ratio provides a valuable reality check for investors seeking growth at a reasonable price and is often looked at in conjunction with return on equity, a reliable growth indicator. Large discrepancies between the P/B ratio and ROE often send up a red flag on companies. Overvalued growth stocks frequently show a combination of low ROE and a high P/B ratio. If a company's ROE is growing, its P/B ratio should also be growing. It's difficult to pinpoint a specific numeric value of a good price-to-book ratio when determining if a stock is undervalued, and therefore a good investment. Ratio analysis can vary by industry. A good P/B ratio for one industry might be a poor ratio for another. It's helpful to identify some general parameters or range for a P/B value, and then consider various other factors and valuation measures that more accurately interpret the P/B value and forecast a company's potential for growth. The P/B ratio has been favored by value investors for decades and is widely used by market analysts. Traditionally, any value under 1 is considered a good P/B value for investors, indicating a potentially undervalued stock. However, value investors may often consider stocks with a P/B value under 3 as their benchmark. Due to accounting conventions on the treatment of certain costs, the market value of equity is typically higher than the book value of a company, resulting in a P/B ratio above 1. Under certain circumstances of financial distress, bankruptcy, or expected plunges in earnings, a company's P/B ratio can dive below a value of 1. Furthermore, a company's market value of equity differs from its book value of equity because the book value of equity focuses on owned assets and owed liabilities. The market value tends to be greater than a company's book value of equity because market value of equity is believed to price in some of the company's growth potential beyond its current balance sheet and captures non-tangibles. Because accounting principles do not recognize intangible assets such as the brand value, unless the company derived them through acquisitions, companies expense all costs associated with creating intangible assets immediately. For example, companies must expense research and development costs, reducing a company's book value. However, these R&D outlays can create unique production processes for a company or result in new patents that can bring in royalty revenues going forward. While accounting principles favor a conservative approach in capitalizing costs, market participants may raise the stock price because of such R&D efforts, resulting in wide differences between the market and book value of equity. Assume that a company has $100 million in assets on the balance sheet and $75 million in liabilities. The book value of that company would be calculated simply as 25 million, the 100 million minus 75 million. If there are 10 million shares outstanding, each share would represent $2.50 of book value. If the share price is $5, then the PB ratio will be 2x. This illustrates that the market price is valued at twice its book value. This is money and investing. Thank you so much, guys, for watching my video. Let me know your comments and what you think below. For those who are still watching, you're amazing. If you like this content and would like more investing videos, please consider supporting me at my Patreon page linked below, or get a free stock when you open an account with Robinhood. If you want more content like this, please consider hitting the like button and subscribing. It will really help my new channel and give me inspiration to create more content like this. Thank you.